Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Thursday, December 11th, 2025. It is 12:55 p.m. as I'm starting the video, and here's what I'm going to do in this one. There will be some levels to watch, key levels that may trigger a trading up, long or short. So that is going to be in here, but most of what I'm going to cover is kind of big picture. I'm going to share my thoughts or really reiterate my thoughts and my own personal trading plan style. And the crux of it is this is we're in the holiday doldrums here. We're between Thanksgiving and Christmas. Just tell you historically, it's typically a very tough period of trading. A lot of whipsaws, due to low volume, year-end position squaring, window dressing, all that good stuff. So again, you normally, as I've said many times, I would probably just take this whole period off unless there's a opportunity, and there may be. Let me say that I may engage and see something that I'm not covered, or some of the things that I'm covering in this video may occur. Some of the things I'm watching for, or there may be something else, and I'm always ready to engage on short notice. I'm not this year. We're not going anywhere over the holidays. I may go visit family on the other coast of Florida for a few days sometime around Christmas, but for the most part I'm going to be around, and that means I can, if something develops, you're going to be the first to know. As always, I'll shoot an email, post out, and let you know. So what I'm going to do is kind of paint the big picture, where we're at. And also reiterate, this is December. Seasonality is typically bullish. You have that Santa rally. You had yesterday the quarter point rate cut, which was fully expected. But what's new is what some of the pundits are now calling the son of QE. If you've tuned into the press conference yesterday, Powell's press conference afterwards, or you just read the headlines, the Fed has effectively restarted a smaller version. Again, you can call it QE Junior, Mini QE, Son of QE, whatever you want. They're going to be buying mostly short-term Treasury bonds, but they said I listened to Powell, he could move out into the out of the Treasury, the shorter term into the mid part of the yield curve, and that is effectively what quantitative easing is. So. And that's got the financials are the biggest beneficiary today. But here's what I'm going to cover in this video. We're going to cover the two big sectors I'm looking at and have been are the tech sector, which of course is the largest by far of the S&P 500, and also of course by far even larger on the NASDAQ 100. So we're going to spend a little bit of time there looking at key levels, developments. And within there, I like to look at the semis as well. We're going to cover that. As I've been repeatedly stating, the market will only go so far without the financials. And this is the big level, about $51 that I've been harping on, that we need to see to get a real correction going, or even possibly the first leg down in a bear market. You're going to have to see the financials take out that. It's very good price support. They've been trading in that range, which I'm boxing in here for pretty much the better part of the year. And it's also their key 200-day moving averages. When the 200s are lost, things are not good in pretty much any sector of the market. So right now, they're loving this. Nobody benefits more from QE than the financial stocks. You've got short-term rates going down, long-term rates along into the yield curve. As I've said, the long end being stubbornly bullish. Well, before the days of gaming the stock market, I mean, let's go way back. That's where the banks were having a field day back in the roaring 20s, along with all investors. We had a comparable bubble in the stock market, and the banks were allowed to partake in the fun. Then the stock market blew up, the bubble popped, the banks blew up, they went bust, and the government had to come in and save them. And then from that point, they set up Glass-Steagall Act, which disallowed banks from taking customer deposits and the money they have and gaming the stock market. And that lasted for many years and kind of got unwound starting back in the early 90s. And so now they're back in gaming the market as well. But where I'm going with that is banks traditionally make money, and your more traditional banks make it almost exclusively in this fashion on what we call the spread. And the spread is simply the differential between what short-term rates are and longer-term rates. So the banks like a normal upward sloping yield curve. That means long-term interest rates, think the 10-year bond, the 30-year bond, versus short-term rates are longer, because what a bank does, it takes your money in and my money, puts it in, in deposit accounts, checking, savings. They pay us what those short-term rates, 3% or whatever you're getting now, and they turn around and they loan that money out in the form of car loans, house loans, business loans, it's boat loans, etc. And that's the spread. So when you have a flat yield curve, meaning long-term rates are down around where short-term rates, they're struggling. So this yesterday's cut in the interest rates and especially the liquidity boost from quantitative easing is a net boon for the financials, and that's being reflected here. So they're comfortably above that level right now. Again, something to monitor, as is what I'm about to get to in a second, the tech sector. Just because the financials are making a new high doesn't mean that is going to continue. Just right now, there's no red flags from a technical perspective, and won't be until we get down below there. Okay, so let's just move on. Something to watch. If I see something else, you know me, I don't just watch XLF, which is a broad base, has banks, credit card companies, and companies like Berkshire Hathaway, insurance companies, anything related to financials. But I do watch those subsectors, BDC, business development companies, private credit, private equity, niche lenders, specialty lending, and all that other good stuff. So always looking for where the cracks may be developing. And right now we have kind of a green light on the financial sector. So let's move on without further ado, talk about the tech sector. And that is best summed up. You can look at XLK, which is a tech sector ETF, or you can look at QQQ, and the two completely mirror each other. So we can look at QQQ, and it's just due to the top weighting, the big tech companies that are the same top components in the tech sector. And again, the NASDAQ 100 is over 50% tech. It has very little, if any, financials. It has almost a zero weighting in financials. The S&P 500, that's the second largest sector. So that's your biggest difference between the two. And I will usually trade, as I often say, the NASDAQ 100 for the juice because they're going to follow each other. The S&P 500, they still have the same top sector, and they're both market cap weighted indexes. So those same top MAG 8, 9, 10, whatever you want to call them, stocks have a disproportionate weighting on the return. So we're going to spend a lot of time there today. So again, XLK is QQQ for lack of for basically as far as performance goes. And QQQ, we can trade futures. That's the benefit there, or the very, very liquid ETFs. And I analyze QQQ on multiple time frames, and I'm going to talk on that. Let's do that now. There's when it comes to trading and investing, the things I wear multiple hats as father of two children, now of college age, wife, family. I wear the hat of a long-term investor, wear the hat of a what I call a trend trader, and which I kind of lump in the same category as a long-term swing trader. Investors are going to put money away for years. Trend traders are going to try to capture trends that are typically measured in many months to even a couple years, and that you can lump long-term swing traders. Typical swing traders, which most of you come here for, and that's the majority of the trade ideas on the site, I say have an average holding period. It can vary depending on the chart and the security, but usually measured in weeks to months, right? And then there's the active or short-term active trading. And that can be day trades are in and out in a day, or just trades that are expected to last maybe a few days. And we've had quite a bit of that lately when volatility picked up recently. I'm going to get to all that. So this is your investor long-term monthly chart. That's about as far as I go out on the charts as far as analyzing. And you can see here we're looking at no change on what I've been saying for over a year now. We've been building divergence. That was the peak back in late 2021, followed by about a 38% bear market. Took us back to our primary secular bull market uptrend line. Let me move this out of the way just to give us a little more real estate. And so that's it. It's a slow roll. If you remember I'm going to quote some movies in here. That's what I like to do. If you remember the Austin Powers, I think it was the second one, the one with Elizabeth Hurley. That scene where they're on the steamroller. It's going a half mile an hour, and the security guards in front screaming, "No, no, don't run me over!" And it's the satire took forever, and he finally didn't move out of the way, and he got ran over. That's what if you're impatient and you're trying to trade or invest off the long-term charts, well, you're going to have to be patient. Monthly charts, nothing in my opinion matters until the end of the month, because that's when the candles are finalized. It is very common. Here's a great example. One of my favorite indicators is the 20-month exponential moving average. That's this blue line here. It defines bull and bear trends. I challenge you to find a better 401k long-term trend indicator. You look at it here simply when the market, in this case QQQ or SPY or the S&P 500 is above it, you are in a bull market. And it captured the entirety of that. Was the greatest bull market in history in the NASDAQ right there. That was the dot-com bubble. And then took it out there, stayed below. It was about an 80% drop in the NASDAQ, and that told you, get out. If you don't short, get out. You would have sidestepped almost all of it, or you would have made a fortune shorting it. It said, hey, safe to get back in the water here. We took it back, and the market just QQQ, you could buy every pullback to it. And then when the financial crisis hit, doesn't look like much, but about a 57, I think, percent drop, give or take, in both the S&P and NASDAQ. It took it out, back tested it, and then clearly lost it again here, and again would have kept you out of the majority of the losses in that bear market, or given you a lot of profits if you were a flexible trader who was willing to short. And since then, and where I'm going to get to well, here's the examples. These are what we call candlestick shadows. When the shadow's down below the body's a fat part, the shadow's a skinny part. It's called a tail. Those tails are intra-month breaks. So if you don't jump the gun, it kept you long and strong throughout. Even when COVID hit, we had a tail intra-month drop down through there. It looked like the world was going to end. QE to the rescue, and we stayed above there. So with this period, you can see that one, you could have blinked and missed it, that drop, and you would have stayed long according to this indicator here. You clearly lost it there, and you had about, I don't think it was a year. I can tell you exactly what it was from that monthly close, this candle right here. It took, this is the recovery candle, the green one that closed back above, 11 months, yeah. So imagine that. Imagine being out while all your neighbors and friends and family were freaking out, had your money put in the cash in your 401k, or you were actually making a lot of money while the rest of the world was losing it. And so, and there's a recent example too, this big drop. That's the Trump liquidation day, as I like to call it. He called it Liberation Day, where he talked about, stepped up to the podium and announced his tariffs, and it proved to be a non-event, and boom, there we are. So again, that's one of many trend indicators. However, when I turn back all the other lines, the conditions it show, is that we have this divergent high. It's the biggest divergence we've had pretty much in as far back as I can go on the NASDAQ on QQQ. And QQQ is an ETF, one of the first to markets, but it only started trading back in the late 80s, early 90s, right there, give or take. All right, and that's it. So you can see those are your potential pullback targets, the 20-month EMA, this white minor uptrend line, and of course this is our secular bull market uptrend line, which I have little doubt at some point in the not so distant future will be taken out, and that meshes with my take, which has been spot on all along on the longer term outlook for treasuries. In other words, we just entered a 40+ year bear market in yields, which is a bull market in bonds. Falling interest rates started back here, peaked in the 80s, and we had what we call a secular bear market in yields, falling treasury yields, which is uber bullish for the stock market, and it's the whole reason the stock market has performed so well over that period of time. Make no mistake about it. To me, that's not up for debate. It's economics 101. Talk to anybody that has a background in finance and economics, and they will tell you there's, surprises not talked about more on TV. And then by every metric, technical, and fundamentals as well. That ended. It ended here with the nuclear response to COVID, excessive liquidity, fiscal and monetary stimulus, and again, by every account, simply just looking at an uptrend being defined as higher lows and higher highs. We have that. We've taken out the primary secular bear market downtrend line. That's another more evidence that says this isn't just a blip up. These were blips. These were cyclical, cyclical bull and bear markets within the larger secular trend. So now how this plays out, guys, it can take a long time. So let's not spend any more time on it now. I could easily see us pull back. A back test of that uptrend line is certainly potential. That would be, falling yields. Should be net bullish for the stock market, but I always put that little caution, not necessarily, because if it comes with the stock market crashing or going down hard, that's a flight to safety bid. If you get an organic abatement in yields, natural pullback in yields, that should be normally as bullish for equities. But so far, you can see the Fed's on their sixth rate cut in the last just over a year. And so far, they've been unable to budge long-term rates. So my expectation is sooner than later, we're going to break out of this trading range here, this circular box, and that will be lights out for the market. At that point in time, I will hang my hat up if the market somehow manages to chug along, if we do see a clear and solid breakout of long-term rates, especially on the 10-year as well. This is just the 30-year. 10 looks almost the same. So that's big picture stuff. Guys, don't get tied. It doesn't matter squat what is on this chart, what the market's going to do over the next few weeks. I told you my preference in December, unless I see something big, is to pretty much cut back in trading, be very selective. Right now, I still favor trading individual stocks, the most bullish versus the most bearish, instead of the equity markets. But let's step down. Let's continue my thing where we went down on time frames. So monthly and weekly charts are for your longer term trend and swing trader. This is the NASDAQ 100, which to me is the most important index to kind of get an idea where the stock market is going. Yes, it's lacking financials. Yes, they are important. Yes, what I said a minute ago, I believe holds true. Unless the financials break down, you're only going to see just corrections or pullbacks in the NASDAQ 100, the tech sector. You'll need to see the financials buckle, even though they're not a big part of QQQ, because just the relationship. If the banks are doing well, this will just be a cyclical rotation. So, or sector rotation out of tech into financials. So you still have the bearish engulfing candles that were put in on the weekly chart a couple weeks ago. You're still, then you broke down below this minor uptrend line. You're still back testing. So nothing has changed on this time frame as of right now. That can change by the end of the year. It could change in a week or two. What would change it? Well, a start would be a solid breakout above. As I said, it will still have, it's not going to change. The divergence will still be there. What'll be different is that bearish engulfing candle technically by definition can't be a topping stick if you go above it. So like I said, it's the market has a way. We put a bearish in there and we took that bearish engulfing out by a slight hair and then went down, put a second one in. So it wouldn't surprise me to see the same. So in other words, a marginal new high between now and the end of the year or early January, to me, doesn't change a whole lot in the technical posture. Again, I'm not putting too much stock into that bearish engulfing candle. We've seen plenty over the last couple of years. Some have played out, some haven't. So there's, and then we have a little minor trend line there. Again, this is a longer term trend swing and trend trading time frame. These are the targets that I've given you now. Remember, we had them back here. We had T3 was hit. We bounced. This is still T3 again. I've just resequenced 1 and 2 because we already hit them on that last trade there. We covered all shorts there on the early April lows right there at the day of the lows. And so this is the next drop. These are still the same longer term trend targets. We just have some work to be done. Namely, as I've been saying now for months, until and unless we take out the October 10th lows in both the S&P 500 and NASDAQ 100, clearly take them out. And that also, roughly correlates with XLF. XLF, I showed you on the daily a minute ago. That 51-ish level right there. So those are your big levels. And whether it is 3 weeks from now or a year and a half from now, I don't think it's going to be that long out. That's when I think we'll start to get some impulsive selling going in the market. So those are your big levels to watch. Let me just step back in time frame a little shorter now. So there's the daily chart. On this last trade here, we were entered on the 15 and 16 minute charts, and then I gave you just two simple swing targets. Again, this is now a daily chart. This is the realm of the typical swing trader, again, with holding periods measured in weeks or months. And so we shorted right off the highs. We hit T1. It was also that key October low. We bounced on that day. We hit there. I reported covering all shorts, going to full long position. And I'll get to those charts in a second. And so this is nothing more than a bounce off those levels. I'm watching the financials give a boost to the S&P 500. But as of now, this is what I would call a yellow, maybe not a red flag, but a yellow flag. The fact I'm seeing a lot of weakness in tech. And so in summary, guys, this is either healthy rotation, maybe letting a little hot air out of the AI bubble. I'm going to speak to both because I can acknowledge both sides. So on the bullish front right now, you have the seasonality, Santa rally. You have now another rate cut plus the son of QE from the Fed. So, I consider all day long, and you can turn CNBC on if you want. The bobbleheads will come out all day long and tell you the bullish case, the bearish case. There's a lot of that out there. I'm not going to sit here and tell you every bullish potential for the markets right now, nor am I going to tell you every bearish. I'm just going to tell you the key big ones to watch, and that to me is these technical levels. So that's that. And I still maintain this target. Remember, I list multiple targets because upon the initial tag of each one, a reaction is likely. That's a reaction. If we do, and again, if there is no stop on this trade because the stop is going to be your stop. If you're swing trading it, as I said, for all the reasons here, there was a high probability of bounce, time to cover and game the bounce. And so I think we'll go back down. That's still my preferred scenario. Whether we eke out a marginal new high, if we do, it'll still be a divergent high or not. And again, I'm going to get into the charts right now and show you what may foil the run in the financials and start this next leg down. So I'm going to give you levels. We're going to look at the semis and the Mag 8 stocks here in a second. So that's it from a swing perspective. Everything's on track. Active traders, what I call an active swing trader, could have covered there, game some, or maybe you're still long this bounce. I went long there. I didn't stay long the whole time. But I'm not, as I told you, I'm not going to add or get aggressively anything in the market at this point in time for many reasons. Number one, we're above that key support. Financials are at new highs, and it's December. I need not say any more than that. But if that changes, I'll let you know. All right, so there's the next target, which would give you, from where we're at today, just to give you an idea, it's another 10% plus drop. Then we step down to the realm of the more active swing trader. Even a typical swing trader, the daily and the 60s are my go-tos. I really like the daily and the 60-minute charts, and sometimes I'll go to the 15-minute charts. I just want to reiterate, and you've heard me say this very often, as a swing trader, this is my favorite time frame. If you're going to say, Randy, you're only allowed to look at one time frame, that's all your charting platform can do, what would it be? It would be the 60s. Again, I would have to give up trading if that were the case, because you have to look at all time frames, because if you're only get lost in the 60-minute charts and you take a buy or a sell signal and you don't see, let's say it's a buy signal, and you break out of a bullish chart pattern, and at that, right after you break out, you hit major resistance on the daily chart. Let's say the 200-day moving averages or a super duper well-defined trend line. You might not see that on the 60-minute chart. So that is why I trade multiple time frames. But this one will get you in earlier. Like I said a minute ago, on the monthly charts, you got to wait to the end of the month. And in some cases, you missed the entry point on an objective buy signal, long entry, or a short entry. We step down a little further as we did on the last trade. Usually my swing trades, I normally don't give them on 15-minute charts, but that was the last one. I used the futures and this chart right here. And I gave you a total of 6 targets, or no, five on QQQ, and then I made it 6 on NQ. I'm going to get to that in a second. We played this thing like a grand piano right here, or a fiddle, however you want to call it. We hit T1, T2, T3. We gamed 1 or 2 of these bounces right here, and then we covered that day. And I'm going to go over those posts. So we've come full circle. This was active trading. Remember, the VIX was going up, and I say this often. As an active trader, this is when I make most of my money right here. And I have to learn to sit on my hands the rest of the time, either keep it light. And again, I'm only right now speaking to the indexes. You can always sit there and, at any point in time, the indexes may be stalling out, going sideways, and there's another sector or a commodity that's actually very tradable at that point in time. So as far as the indexes go, what I want to say, we've come full circle. And I've been saying that since right here. This is a 15-minute chart, but the same thing on the 60. We have a divergent high, just made a marginal new and still divergent high. And this right now, about 618.35, I think is a level to watch. You can see the negative divergence. And again, this time frame, there are no guarantees. Sometimes divergences get burned through. As I say, they are not buy or sell signals, but they tend to telegraph a trend change. And again, a trend change commensurate to the time frame you're trading on. Don't think you get a 60-minute or 15-minute divergent low or divergent high on the 15-minute charts. Doesn't mean you're going to end a bull market or a bear market. It just means you're going to get a counter trend bounce most likely. So there's the level. You can see we hit it today. This is really nice support. It's a line I've had here for a while, 618-ish. And what I don't have right now, like we did back last time when we had this trade, we had a beautiful wedge right there. And I'm going to go over and walk you through this trade. And now I don't have that. This is sloppy trading. I have horizontal support, and we hit it today, but I don't have a clean uptrend line. That was a very nice, what I call a high probability sell signal. That's why I gave you at that time all those targets. And here's that chart. And my charts are always time and date stamped for convenience. You can get an idea of what time they were taken at. I'm trying to squeeze it in here. That was it. So from here, going down to here, that was the biggest drop that we had in many months. We also, with near impunity, shorted there and covered. We had a little. I used the futures and we hit my final target right about there, but that took us down. So that was it. That was then calling it down from about 635 to 590. And we went down. I changed them to yellow after, because if I give you new trades, I'll make them white. And that was it. That was it. We made the whole juice. And then that day right there, as posted, when the markets are going to be moving fast, I'll do this if I don't have time, because it does take time to screenshot markup charts. If I'm trading, especially if I'm in positions in multiple accounts, different brokers, I've got to go in, log into some that time out. And my active trading account always stays open. That's a professional trading account, so that's easy to maneuver in. But the other one, so that was it. And that was that morning of right there. Cover them all, 11:30 in the morning on the 21st, and go long. And that was right here, November 21st, right at that low. And so that's it. We've come full circle, guys, and let's walk through that trade, how it played out. Okay, to kind of recap, on October 29th, that was the high. There was that wedge break. Again, that's his futures. Walked it through. Gave you at that point in time 5 targets, but then I added one more to mesh with that or the final target on QQQ, and you'll see I'll get to those. So that's it. Had us going down there. Okay, and as I always say, every tradable trend consists of waves and different moves. And you never go straight down from point A to point B. There's always little zigs and zags along the way. So on the 7th, just shortly after, remember we shorted right here. We went on to make a back test, still marginal, ever so slightly, kickback, higher high, still divergent high. And when we got down here, I started highlighting we had a nice bullish falling wedge forming. And a breakout above that 60-minute bullish falling wedge would likely spark a counter trend rally, especially if stocks can regain the uptrend line it lost. From there, we broke out of that bullish falling wedge and gave you a precise likely endpoint for the counter trend bounce, meaning that that clearly states if it's a counter trend bounce, we're not going to new highs. We're going to go down and hit my next targets. That was on the 10th. And then 2 days later, on the 12th, we had a nice wedge formed, an uptrend line, bearish rising wedge, right smack in the middle of my bounce target zone. And again, this is just juicing the returns on the trade. And with a sell signal to come on a break below that 60-minute wedge pattern, which would then take us down to the next target. And I even followed up right after that. We did break down. That's that same wedge. Just took I had hand drawn in the shaded area. And that's it. So there's go time. That means cover your, if you didn't already sell your longs from taking the bounce, turn around, reshort, go down, and again, juice up the return. And that's all she wrote. So you were able to short here, game this bounce, long, cover your shorts, game the bounce, reshort back there, close your longs, and we hit that 6th and final target, which without mixing words, I said final near-term target hit, full reversal from short to long, bounce targets to be determined. And then posted some additional charts, short-term stuff. This was just a 5-minute chart. That was the lows when the final target was hit. I'll give you a 5-minute chart, bounce target, able to go there, reverse short to long, and then go cover that again right there. And again, I started getting micro because volatility was high. That's why you saw more 5-minute charts. Not seeing that now. Volatility's come back down, so you're not getting these 5-minute charts lately. But we were able to turn around there, and that was if I recall, that stopped that pullback. And again, had us going up a little more. And that was just, that was a couple weeks ago, the 19th. Oh yeah, and then remember that was a bounce off T5. And then this is where I added that T6 just to make sure that aligned with and that was that bounce I just showed you there. And that was it. T6 was the final target. And I already showed you the hard reversal off the lows. All right, so... and I'm showing you here, this is a 5-minute chart, or 15. So I did get one recent out to you, one short-term trade. There was an uptrend line. See, I like these uptrend lines. I like these wedge patterns. And we hit my first target, hit it again, bounced again. What I often say is upon the initial tag, a reaction's likely. Sometimes you can hit that level again. And until it goes, you're not going to open the door. You need to take out that first target. So things that went sloppy since then. Remember, what happened is we started getting up, the Fed was coming up. And it had the opportunity to play out before the Fed, but then we had Fed come up yesterday, and that just kind of, you can see QQQ is a mess. It's just sloppy. And so this is why I'm not right now giving you 15-minute chart trade ideas and telling you personally, I'm just rather sit on my hands and try to trade this grind, which is almost untradeable with, now that the Fed's over, the dust will settle. By that, I'm referring to what I call the post-FOMC dust. You heard me say yesterday, I put literally less than zero, cited that movie from the late 80s, less than zero on the post-Fed reaction. This is 2 p.m. right here. Post-Fed reaction, initial was up, pulled back, and then a nice post-Fed rally. And you should have seen the headlines immediately before the market closed. Oh, bullish, Dow had its best day since blah, blah, blah. And as I said, I'd put less than zero weighting on that. And you can see what happened is that rally, if you jumped into it or if you bought into the hype or assumed that that's where the market was heading or QQQ, well, you bought in and then you rode out about almost a 2% drop, and that's where we're at. So right now, just to summarize, we're right back to, this is 2 p.m. right here. It's my 2 p.m. hash line. This is where the Fed announcement came out, and we're right about where we were then. So we went way up, we went just as much down, and we're back to where we started. That is what I call post-FOMC noise. So if you somehow were able to successfully trade that, awesome. More power to you. I'd love to know, but I say I'd just stand aside. That's just untradeable noise. But then the noise will abate. It usually takes through tomorrow. That the Fed meeting's Tuesday afternoon. The announcement's at 2 p.m. Powell comes on at 2:30, does his dog and pony show. That runs for at least half an hour. And so it's all the volatility, and then everybody's trying to parse that data and figure out what it's going to mean to the markets, and that usually takes a couple days from there. So by next week, we'll see which way things are going. And like I said, right now, charts are unclear to me very near term as to what they're going to do, what the indexes are going to do. All right, I have some other charts to cover before we move on. Let me just show you the S&P, what it looks like. This is ES, the S&P 500 futures right there. You can see what I can tell you, despite the rally in the financials and the fact they're holding up, this was the high right here, the previous high on ES, the S&P 500. That's that same wedge we broke, we shorted, came down to that divergent low. This is again the simple trading style. It's not marked, but that was a divergent high correction. A divergent high drop. We did short that one, caught almost all of it using NQ. Went up, put in that divergent high. That was our last short entry in our swing trade. We gained that counter trend rally. We shorted, reversed back to from long to short here, took it down to the bottom, covered everything that I think that was the same low right there, and that was also a divergent low. So we've come full circle. This is what I'm trying to impress here. Markets seem to have a nice bid. At least the S&P does today. The Nasdaq's still down. It's been down all day, and that's unusual. But I'm going to talk on that a little bit more. What I can tell you is this is still on my go-to swing trading time frame. Nice negative divergence in the S&P 500. So despite Santa coming and giving us rally and new quantitative easing or the son of QE and all that other good stuff, I wouldn't be chasing this rally. It's not enough evidence to short it right now in the S&P. Again, until we take out some of these, maybe these recent lows right here, that level you'd want to see go. So I'm just reviewing the charts so you have them all there. Again, that was the last trade, and that's just gone nowhere. It's not a loser. If you shorted here to cover, to make this, you're still well within any reasonable stop parameter. It's just taking more time than trades based on the 15-minute chart usually do. One more time frame for you. And again, this is my NQ 60-minute chart. You get divergent high. That was our two targets. 1 and 2 both hit. Reversed it there. That was our last trade there. Down to the final target. Put in, that was a divergent low. And here we have two equal recent highs, both divergent highs. There's our divergences. And this is a level that should bring in more selling in the NASDAQ. So now let's talk about that. Let's jump out and talk about bigger picture stuff. So the way I see it right now, there's two camps, and they both, you can sit here and debate it all day long. I think there's merits to each one, the bull and bear camp. The bull camp says this is healthy sector rotation. What I'm going to speak to is the weakness in the Mag 7, big tech stocks, the AI trade. And so the bull camp is going to say that's healthy sector rotation. They needed to let a little hot air out. And while tech is correcting, money is going into financials and other sectors, right? And we have plenty of long trades on the site right now. So there's money to be made. It's just a stock picker's market at this moment, not a broad market, trade. Then the other side, which is really where I lean towards, says that, as I've been saying for years, um, live by tech or live by AI, die by AI. This market has been, nobody can argue the impact that AI and the impact that the magnificent 8, 9, 10, whatever you want to call them, the top leading tech stocks have had on the market. It's a circle jerk trade. We all know that. Money going from one company, from Google, Microsoft, into Nvidia, who then turns around and puts money into other Chat GPT and other semiconductor companies and chip makers and all this. And it's just again a circular trade, which is bullish. It's almost like a shell game, if you will, or I don't call it a Ponzi scheme, but it's money. It's money moving hands, changing, and it's creating real earnings, but creating a massive amount of debt that is the big bet is, will it pay off? Will all this AI pay off and offset all the capital expenditure right now going on, capex spending? So let's talk about that. So what with the financials doing so well today, what knocked the snot out of the tech stocks? Well, it was Oracle last night. Now, if you recall, Oracle had one of its strongest days in its history recently on all AI news after last earnings right there. So it was almost exactly 3 months ago. And it sent the stock up to, I believe, an all-time high. And people were literally tripping over themselves. And you can see what Oracle has done since then is nothing but fall from that point, 45%. You guys have heard me say repeatedly, I've done this a long time. Think Apple, think Amazon, think even Nvidia. Every major top, every end of a bull market I've seen, the majority, I shouldn't say every, most of them come on, you would think, a bad quarter, big miss. It's the opposite. Almost every major top I've seen come on these big tech stocks have come from record blowout earnings, beat expectations. And what just happens at that point, that's it. It's run its course. The stock's overvalued. The last of the bulls have bought his or her shares. I mean, there's no one else left to buy. Think about it. If you've got $100,000 to spend and or just Oracle's on your only stock, and you think it's going to go to the moon, you've got all your 100,000 or your 400,000 because you're leveraged up 4-to-1 with your broker on margin. What do? You don't have any more. You might talk the bullish talk. You might, but you don't have the capital to commit. So that's, again, metaphorical, not literal, but it's kind of how things work there. And who'd have thunk it would have dropped? Well, I've had several updates, requests on Oracle. And so starting back on September 25th, you can see where I had us going. Big old gap to be backfilled right there. So I had us, once this level was taken out, I said we'd go down here, work our way down to 243.86. I don't know if the recorder was working. So that was the breakdown there. We entered the gap. We went down to that 243.86 target I had. Even had that bounce along the way. You can see the first reaction for 3 days right there where I had us going in the middle. Bounced, held it for 3 days, took it down, then hit my 243.86 target. And also had a bounce. Small reaction, bounce, same thing. Held it for about 3 days, lost it, back tested it. Then the stock went, I posted this one on the 18th of November, testing the key 200-day moving averages and price support there. Next update, November 25th. We took them out. 200s were taken out. Said, although it's very oversold, so the odds for a counter trend bounce or short covering rally is too high to short it this time, somebody asked. Although any bounce to back to the 200 days and or 218 resistance would provide an objective short entry. So that's what I was saying there. We bounce back, 218, the 200s, you'd get an objective short entry. And that was then. And then the last update I gave was on December 5th. And that's it. And it's exactly what happened. So if you heeded that advice, you didn't short it there. You waited for the bounce back to the 200 day exponential and the 218 level. You had a perfect entry, had us going down, and still do. Again, that was just a few days, a week ago, December 5th. And that was then, this is now. So this is where I'm going here, I'm not just harping on, okay, these were the calls here. These were updates from somebody asking. But it's showing you that this is one. And again, Oracle was deemed a big player, big part of the whole AI hype, AI bubble right here. And so far now, it's dropped. And the technicals are leading the way and showing us where it's going. It's dropped 45%. Let me repeat, you've lost half of your money, nearly half, if you bought into that hype there. And the media, I was there that day. I turned on CNBC because I saw the big move in the futures. And the bobbleheads were literally tripping over themselves, foaming at the mouth, bullish on Oracle and everything AI. And so what I'm seeing here is sort of I can't call it the implosion yet, but a lot of signs that this AI bubble has peaked. So we're going to go through the rest of them. So I had to, basically we're at the bottom of this gap right now, that 189.85. The reason I have that line there's a gap right here. And so that's why I had that arrow going, taking us down here. And at that point, you're going to have positive divergence. At that point, I'll tell you, I really like the stock. You already have potential divergence right now. You have about an equal low. But that would be a nice buy point, I think, around just above 179.36. The stock will be oversold. Again, assuming that the rest of tech doesn't blow up. And this is certainly going to move with tech. But all right, let's go over the rest of them if you're still with me. I know this is, I warned you, it's not very actionable. Some of this stuff's actionable if you're trading into these stocks. But let's take a look at this is I'm going through what I did is I queued up the NASDAQ 100, QQQ. I don't know if you saw that. And as always, I have a watch list or the component list, and I keep that sorted. I can toggle it by percentage gainers or whatever other criteria I have, next earnings date, whatever. But I usually keep it sorted by market cap. And the reason is, as I said, this is a cap-weighted index. So if you want to know where the NASDAQ 100 or the entire stock market is going, you only have to know where the top 5, 6, 7, 8 stocks are going because of their cap weighting. It doesn't matter what the bottom 30, 40, 50 do in the NASDAQ 100. Their weighting is so small, they don't move the needle. So, and again, if nothing else, NVIDIA, I think we all agree, is the undisputed poster child of AI. And so here it is. It's not it's not end of the world. In fact, it's just been grinding around. It's lost its 50-day moving average, which I highlighted. It had been holding it. But sometimes in these grinding, I get away from emphasis. I had a price alert, and it keeps going off every day now because you're going up and through the 50. What happens is sometimes when you break a key moving average, that's it, and the sellers start to step in. But when you get in these trading ranges, get away from using moving averages. You're going to get whipsawed to death. So once you recognize a trading range, what I'd probably do at this point, I mean, I still have these are the big ones here, the 200 exponential and simple. Either way, NVIDIA has stalled out, and it could be high-level consolidation before the next leg up. That's the bull case. The bulls are saying, okay, needs a little breather. Well, again, that was a record blowout quarter. They didn't have a negative thing to be said about NVIDIA. Their biggest and only problem is they have more business than they can handle, which is a great problem, as you guys know, if you run a business. But yet, it's just the dryers abide up. And maybe it's temporary again. We'll just, we'll see where we go. When I look at the long-term chart, this is what keeps me longer-term bearish. I'll roll back as far as I can. So this stock came public back in the late 90s. I count 1, 2, and again, I've had these here for a long time, 3, 4, and now 5 divergent highs on this weekly time frame. That first divergent high, the stock dropped 90%. After that, second one, 86%, then 56, 69, which was, we had long-term targets. We hit one of my price targets. That 69% drop, we've gone up. This was a divergent high, but it's still, and we did. It's not as if we didn't. We hit my first target. I have a total of 4 price targets. And as is often the case, we had a reaction. And we also covered all shorts and went long that day. That was April lows. So again, it's still just an extension. This divergent high, it didn't reset. This was a reset. That divergent high, you no longer had it here. That was it. These were separate divergent highs. This is just one even larger divergent high, which indicates that when the trend change it gets going underway, you're going to have a much bigger drop. So I don't think it's unreasonable at all to expect this stock to fall anything less than 70%. In fact, that's my final target, was measured from right here, and I gave these to you last year. 72% drop to my current final target, T4, which now, if it's hit from the recent highs, assuming that proves to be the high, that's going to be a drop of 80%, which again is right about in line if you take an average of what these drops were before. That's that. Apple, I'm on a weekly time frame. I'm just going to stick there now. Biggest divergent high that I've seen pretty much in the entire history since I've been charting this stock. I've done the same thing here. I've marked all divergent highs on the weekly chart. I've covered this with you many times. 82%, 42, 62, 45, 34, 39, 35. And again, that last divergent high gave you a 35% drop, and this is simply an extension of that divergence. There's your uptrend line. Yes, we have an active trade on Apple, and so far it's managed to elude the stop. I put a stop on a weekly close above this line. That was on a Monday right there. So the Friday we closed below it, went up, looked like we were going to get stopped out, and then what do you know? On Friday we closed. That's a red candle, means the body, the fat part, we closed down back below it, and we've remained below. Now, again, guys, if you're in this, I don't have strong convictions on it at this time. I wouldn't short it right now. If you're in it, you can do what you want, but it's just grinding around. I'll make it official. If it closes above that line, I'm going to stop it out and take it off the site, and then you can decide whether you want to hold on to it. I have little doubt that those long-term technicals I just showed you, that weekly chart, will play out. Let me see if I can get a trend line going off the lows here. Ish. I don't want to force it. Kind of have an uptrend line ish right there. We'll see. Either way, that's what Apple looks like on the daily chart. Here's Alphabet, my daily chart, little gap that needs to be filled, and then an uptrend line, which will be significant. But let me just go to the weekly chart because this paints the big picture. Alphabet on the weekly, the stock came public back in 2004. Put its first weekly divergent high in there, and it fell back, dropped 65%. You can see on Alphabet, you have this primary secular bull market uptrend line. There's so many of these key stocks in the indexes that have these beautiful uptrend lines. Remember, this is a period of the easiest money in the history of the U.S. Financial markets, and so you have these mega tech companies and a lot of things, everything going up, and those are the secular bull market uptrend lines. So even if you're of the mindset that the U.S. is always going to be in a bull market forever and there'll never be another real bear market or a recession, I think at minimum you can acknowledge that we're going to come back, as we always do in a bull market, and test the uptrend line, right? And if so, to test the uptrend line now, and again, depends if and when we hit it. But let's just say that has us dropping down there in about 8 months. It's going to be a 45% drop. What I can tell you definitively, besides the fact this was a divergent high, that was a nice correction, bear market, that was a divergent high, another correction. This is a divergent high. It's simply extended. But as you can see on my notes, I've done this for a very long time, and I've yet to see a parabolic. This isn't a parabolic line tool. I don't think I have one in this. Let me see here, 1 second. Yeah, this charting platform doesn't, so I'll just draw it up. When you start going like this in an increasing slope, that's a parabolic uptrend. And from my experiences, those almost never end well. What I mean by that, you don't just kind of correct in time. Sometimes when a stock is ahead of itself, you have a little pullback, little sideways action for a while to work off the overbought conditions, and then your next leg up. Parabolic uptrends usually end pretty ugly. And so I have a second little minor uptrend line here that might do the trick. I don't have any type of sell signals right now on it, but if I go back to the daily chart, you can see there's a gap right there. It's been back testing that gap. This is what we call a potential. Again, potential island cluster top. An island cluster. You can have a single island candle if it's separated by gaps on both sides and it's the only candle up top, or in this case, you have a gap up, which you had right here, and there's your gap. If should this stock gap down below this island, and then the island's separated by gaps on both sides, then that's what we call an island cluster top. They're a pretty decent, fairly reliable topping pattern. And meaning from that, you would expect you can short, you can put a stop a little bit above the top of, or maybe around the midpoint of the island and just let it run. And based on the divergences, you'd be talking high double-digit gains if it played out. And there's an uptrend line as well. You might want to wait to see that uptrend line right here get taken out to add to it. So I'm kind of, again, showing you the state of the union, if you will, among the big tech stocks. So financials are doing their thing. Microsoft, let me jump out back to the weekly here. You can see my daily. Let me just drop. That was an equal and still divergent high. That was a divergent high right there. So is that. Then we took out this yellow trend line. You can see we hit that 495, 493, 51 support, bounced. Also, we took out the 50-day. This yellow line right here is a 50-day. We back tested that, got rejected, then fell below that level, and we've been testing. Microsoft has been testing. The red line is your 200-day exponential moving average. The blue is a 200 simple. I keep them both up because some traders like one, some like the other. Therefore, I like them both. And the strategy is wait to the last of the two breaks before you can say lights out. Because if a trader only looks at the 200 exponential and he or she shorted the break of it, well, they didn't realize that a lot of buyers stepped in and bought the 200. 3 different days there it hit. And so now when that goes, that will be a technically significant event. These are the purple lines I have where I think Microsoft's ultimately going on my weekly chart. And we broke this uptrend line. And again, we made just an equal, but not higher high, still divergent high. We're moving lower, but right now this was holding these 200 days like a world champ. And if you turn off all the lines, a lot of these tech stocks, just like the indexes, behave very well. They get under the 200s. If they don't snap back soon, that was COVID. Remember, it was over before you knew it. But here's a break and a back test followed by rejection, second rejection, kept that bear market alive. And then right here, it took them back. It says bear market's over, new bull market. You want to start buying pullbacks to the 200s. That's your MO. 200s were lost here. You had a nice drop, very tradable. They were regained here, and we're currently testing. So there's the state of Microsoft. At support, if you are very bullish, you can buy it here with a stop below. If you are very bearish, wait for a breakdown below the 200s. This is a weekly chart, so when you put them on a weekly, it's 40 week, and that says 40 week exponential and simple moving average on the weekly chart. Same thing as your 200-day moving averages because there's 5 days in a week, so 5 times 40 equals 200. All right. Amazon, weekly chart, turn on the lines. Big divergent high. And again, this is, I see board 8, what I have on board 8. Board 8 just shows the history of this stock. That was a divergent high, 95% drop. Divergent high, 62. Divergent high, 36. Divergent high, 57. Divergent high, which I just need to take this, borrow you. It's not as if that divergent high didn't result in a correction. I'm going to measure it for you. It doesn't look like a lot, but it was a drop of 34%. In other words, the stock got cut in a third on that drop, but I'm using log scaling, so it just doesn't look like much, but you would have felt the pain or profited a lot short. And now all we've done is simply extended the divergence, and it's grown even larger now. Just like back here, that was a divergent high, had a little drop. And that's the thing about divergence. Usually from my experience, the third time's a charm. Divergent high 1, 2, 3, that's usually, not always, but usually the last of them. And then you need to take out those 200s, then the trend line right there. And then you can see these longer term targets right there on Amazon. On the daily, that's what it looks like. Turn off all these lines that I have. You can see it's fighting to defend those 200s. And it's very clingy. In a strong bull market, you usually come test the 200s, or in this case, you undercut it briefly, and then you're off to the races for your next uptrend. Lately, this one, they keep buying the 200, but it's not really doing a whole lot. It's still in close proximity right now. But it is above them, so you can't get too bearish at this point in time until those levels are taken out. All right, and I could keep going. This one splits, all my lines move. This is one bad thing about this charting platform is once you have a stock split, see right here, 10 to 1, the lines don't readjust for price. I have to replicate everything. So I can just tell you, like everything, and these guys are putting in big divergent highs. And divergence, again, it's not a sell signal. It's just merely a condition that is often precedes trend change. Meta, oh, I'm on the wrong board. Meta right here. Divergent high, breakdown of that uptrend line. It's also lost its 200, is back testing the 200s from below. I'll show you that on a daily chart. That was it. Divergent high 1, divergent high 2, trend line break. Lost the 200s right here in one fell swoop and came up. And I think I just highlighted this for you the other day as an objective short entry on a back test of the 200s with a stop somewhat above. If it regains them, that's bullish. That's nothing but bullish unless it's a whipsaw, right? So it's very simple, guys. It's, you know, a lot of these stocks or the markets, you want to be long when you're above the 200s. You want to buy pullbacks to the 200s, or you want to wait for a break below the 200s to short, and then or wait for a back test of the 200s. Again, assuming, guys, this is important, assuming that stock, quote unquote, behaves well to the 200s. Some don't. So I look at every chart, every stock, and I see, did the buyers step in at the 200s, and then do they sell it when the 200s are taken out? Yes, yes. Check. Check. And that was, again, nice drop, and then it recovered there. And so if you shorted that looking for more, you just realize, oh, well, it took them back, lost it again. If you purely do that mechanically, and I'll let you, you will see how you would vastly outperform the market. You'd outperform Meta. And again, to me, it's one of many factors. It's not the be-all, end-all. That's why I do these long-winded videos, and I look at all these stocks collectively. Bearish engulfing candle, divergent high so far, and it's Tesla. It's just kind of, it's still, I don't know what to say. It took out this trend line here, it took it back, it's back on it. It's just trading kind of sloppy. And so I haven't had any trades personally on this or officially on the site for a little while. I'll analyze it. I'll show you what it's doing. When I look at the weekly chart, there's a big, you know, the weekly charts are all telling me the same thing, that, you know, once these big multi-year divergences, play out, it's going to be for a trend change that most haven't seen in you know, a generation or two. And so those are long-term targets, but you got to break each level. You got to take that trend line out. Here's a case. There's that same trend line I showed you. We had one little whipsaw, one little weekly close below, and we got right back above it. And so that needs to go, then this level, and then this more significant uptrend line. And then these are your longer-term targets for Tesla. I guess I could probably stop here. I was going to go over the stocks. I really wanted to, but this is too long, this video. So I'll just look at, and I meant each individual component. So I'll just show you my weekly chart. And the stocks, the semiconductors, is just a very cyclical sector. It's boom or bust. But, you know, these corrections, quote unquote, my little air quotes, the corrections, even in a secular bull market, are very, very big. 68% off that divergent high, 29%, 28%, 27, 39, 48, 45. And this is by far the biggest divergence we've had really in many, many years or decades on. And so when it comes down, you know, it could go higher first. I don't have strong convictions, but I think the upside's limited, and I think it'll come back and visit this primary secular bull market uptrend line, which is going to be a drop of about 44%. In fact, I've given you targets on the, oh no, that was the last trade. That was back here. We shorted that breakdown and hit my sixth and final target right there of 148.19 on the weekly chart. There's that primary uptrend line. So right now, let's just say that is the, that'd be your final target. It comes in around that T3, that former T3 price level, about 195 in the uptrend line. That's a 38% drop. And I think that's a very realistic and in my opinion, conservative target for the next drop in the semis. All right, guys, I'm going to wrap it up here, get this out to you. I may or may not do one on the individual semis. I think it's important to me. I look at them all because collectively I want to see the majority of those breaking support, or I can make a case to short the majority, especially the top components. And the same thing here, you know, I have SOX, here's all my components in by market cap: NVIDIA, Broadcom, Taiwan Semi, ASML, AMD, Micron. And so if you can go through and make a case on the top, you know, 10 or so, you know, right there, you know, you can see it's starting very close to a sell signal, very close to a sell signal in Taiwan Semi. Just broke down, but it's not going down because the majority aren't going down. A lot of these are sitting right on the line. And so, you know, that's, you just need a little work on the downside, or they bounce again, and then we wait to the next time they come down here and look to short. All right, I got to wrap it up here. Long video. Let me get it out to you guys. This has been Randy Finney with Right Side of the Chart. Have a great day.